You know that feeling when you're at a party and it's almost a little too fun? Well, that's kind of what the stock market feels like right now. It is absolutely exhilarating. We're seeing new highs all the time, but there's that little voice in the back of your head saying, this feels kind of dangerous. Today, we're going to unpack that exact feeling. We're calling it the donut shop market paradox, and we're going to figure out just how much of a sugar rush this market is on.
And who better to help us figure this out than the legend himself, Warren Buffett? This quote, this really gets to the absolute heart of the problem. It's such a simple, powerful idea. The value of all the stocks out there can't get too far ahead of the real-world economy, the one that actually makes the stuff and generates the profits. So, what does this paradox actually look like? Well, it looks like the NASDAQ blowing past 25,000. It feels like this incredible sugar high of valuations, but you're left wondering, what's the real substance underneath? This is the puzzle we're trying to solve today. How can everything feel so good and yet so incredibly risky at the exact same time?
Okay, to solve this, we're going to need a tool, and we're going to use one of Buffett's all-time favorites. He literally called it probably the best single measure of where valuations stand at any given moment. Think of it as our thermometer to see just how hot this market has really gotten.
And the thing is, this isn't some super complicated Wall Street formula with a million variables. It's dead simple. It's just a ratio. It takes the total value of all stocks and divides it by the total value of everything the country actually produces in a year, the GDP. It's just a fundamental reality check. So what's the reading on that thermometer? Well, here's the number that should really make you lean in a little closer. Right now, the Buffett Indicator is sitting at roughly 220%. Let that sink in. The paper value of the stock market is more than double the size of the entire U.S. economy. In Buffett's own words, when you're at levels like this, you are playing with fire.
And this chart really puts that number into perspective. Look how far out of line we are. Historically, the sweet spot, the healthy range for this indicator, is somewhere between 80 and 120%. Fair value? That's 100%, 1-to-1. So where we are right now, it's not just high, it's completely uncharted territory.
Okay, so a 220% valuation is a crazy number. But what does it actually feel like for an investor, for you and me? To really get that, let's bring this whole conversation down from the clouds of Wall Street to something we can all understand on Main Street. All right, imagine we're going to buy a business together. We find this perfect little donut shop. It's a great, solid business. Every single year, like clockwork, it makes $200,000 in profit. Simple enough, right? The big question is, what are we willing to pay for it?
So let's look at two different prices. On the one hand, there's a reasonable price, $4 million. That's 20 times what it earns in a year, which is a pretty standard valuation. But then, there's today's market price, reflecting this superheated economy, $8 million, for the exact same shop, making the exact same profit.
Now, if we pay that reasonable price, the math is pretty easy, right? It'll take us 20 years to make our initial $4 million back. In the world of business, that's a solid deal. That makes sense. That feels like a real investment.
But what happens at today's inflated price? Well, that payback period doubles to a staggering 40 years. Just imagine that. You'd have to run that donut shop for 4 decades just to break even. So you have to ask yourself, does that sound like a good investment anymore? And I just love how the source material for this explainer put it. Paying a 40-year price isn't really an investment. It's, quote, indentured optimism. You're basically signing up for decades of just hoping nothing ever goes wrong, just to get your original money back.
So, if the entire market is starting to look like that 40-year donut shop, what are professional investors supposed to do? Well, this is where the pros start looking past the hype. They're trying to find real value where most people only see that sugar rush.
And one of the key things they're seeing is this two-speed economy. It's fascinating. You look at a company like Delta Airlines, and they are crushing it because their premium high-end customers are still spending a ton of money. But then you look at PepsiCo, and they're seeing sales volumes drop because their everyday customers are really getting squeezed. It's a tale of two consumers out there.
And this leads to some really fantastic contrarian thinking. So while everyone was looking at Caterpillar stock hitting an all-time high and thinking, oh, we got to short this, one analyst just said it perfectly. He saw that this whole AI boom, with all its data centers, has a huge physical need: copper. Lots and lots of copper. And who makes the machines that dig up all that copper? Exactly. That's looking past the hype to see what's really going on.
Okay, now for a more advanced move. This is how you can find value when everyone else is hitting the panic button. you look for something called the kitchen sink quarter. It's a strategy where a company intentionally makes things look as bad as humanly possible, all to set up some big wins down the road.
So here's how it works. A new CEO comes into a struggling company. What do? They take all the bad news, all of it, and they throw everything, including the kitchen sink, into one disastrous-looking quarter. They take massive write-offs. And why do they do this? Because it sets the bar incredibly low. It makes it super easy to beat expectations for the next several quarters and look like a hero. It's basically engineering a turnaround story.
And we just saw a perfect real-world example of this with a company called Helen of Troy, stock ticker HELE. The stock got absolutely destroyed, it cratered 25% on weak guidance. But if you look closer, you see a new CEO just pulled off a classic kitchen sink quarter, a $326 million write-off. So it looked like a complete disaster on the surface. Well, for a smart investor, that's actually a classic setup for a potential long-term win.
And that brings us right back to where we started, back at the donut shop. At the end of the day, this is the question that the Buffett Indicator and this whole situation forces us to ask. When you're paying double the price for the exact same donuts, for the exact same profits, you really have to think about what your role in that transaction is. Are you the investor making a smart long-term bet, or are you just the person paying top dollars so somebody else can cash out?